Hey everyone, Dalton Grados with Grados Capital here, and I want to make this quick video about the risks of short selling. So I come into contact with a lot of people and have a lot of good conversations with people around trading. You know, in my friend circle, people always ask me questions about trading and the stock market and all that stuff because they know that's what I do. And I've noticed that for some reason, there's a lot of people that have a knack for short selling. I guess it's because it's just kind of contrarian. You know, it's kind of like the taboo thing to do. Like, oh, you're gonna go bet against a company, and there's movies out there that make it appealing, like The Big Short, where they're shorting the housing market, and everyone thinks they're crazy, and then in the end it all comes tumbling down, and they make all this money while everyone else is suffering. And so the idea of short selling, I feel like to some people seems appealing and sort of cool and the taboo thing to do. And I think a lot of people, especially those new to trading and the markets, don't necessarily understand all of the risks associated with short selling, why it's way riskier than being long a position. And so I just wanted to make a quick video about that. So let me put it very simply. If you are long, meaning you are buying shares of a stock and you want it to go up and increase in value over time, the most risk is just what you're putting into it. So say I put $100 into Amazon stock and get some fractional shares of Amazon. I will make money when Amazon goes up. And if Amazon crashes and burns and goes to zero, the most I can lose is just the $100 that I put into it. And of course I can sell before then to mitigate my losses. Now if I'm short selling a company, by nature I have to use margin. So that automatically adds a layer of risk, because essentially what I'm doing is I'm borrowing the shares from my broker. So I'm selling shares that I don't own, and when it goes down, I can buy them back at a lower price and then make a profit. I'm selling high, buying low, essentially just the opposite of being long, being short. So by nature, my maximum loss potential is not what I put into it. My max loss is unlimited, because if I'm selling shares and I want those shares to go down, in theory, not in practice, but in theory, those shares could just keep going up and up to infinity. Whereas if I'm long a stock, the lowest it can go is zero. And the most I can lose is what I put into it. But when I'm short selling, I'm using margin, and if it just keeps going up to infinity, eventually I have to buy back that position at whatever it is, and my potential for loss is much greater. And a lot of people saw this or were introduced to this with the whole GameStop fiasco. That was what's called a short squeeze, when retail traders bought up a position and all of those traders together buying it increased the price of it, and then hedge funds that were short had to close out of their positions, but because they were short, they had to buy back those shares, which big money from hedge funds buying back all those shares causes it to go up even more. And so by all means, short sell. People make a lot of money short selling if you know what you're doing, but I just want to at least lay out the risks so that whoever's watching, maybe a new or inexperienced trader, can understand you're on margin, so you're selling something you don't own, and the maximum loss potential is technically unlimited. Not to mention that when you borrow something on margin, your broker charges you interest for it. So that's why I always like just trading with my own money, because at least if I lose, I'm not paying interest to my broker on the money that I borrowed from them that I then went and lost. Now, if you have a knack for just making money when things tank, I would say the safest way to approach short selling is buying puts or selling calls. Now we're talking about the options market. So I am an options trader. I don't trade shares of stock. I trade options, which are derivatives of a stock, meaning that their value is derived from the price of the stock. And if you don't know much about options, there's a lot to learn, but just at its very basic level, calls are what you buy if you want the stock to go up and you're bullish. Puts are what you buy if you're bearish. So you can buy a put and your max risk is just whatever you put into it. So I spent $100 on a put, and when the stock goes down, my put increases in value. But if the stock goes up, the most I can lose is just $100, whatever the premium was of that put. Another way to do this is you can also sell calls or sell call credit spreads. This is a bit more complex if you're new to options trading, but essentially you are selling a call, which is a call, you would buy it if you were bullish, right? But you're selling it and you're collecting the premium on it, and whenever the stock just stays the same or goes down, you collect that full amount of premium. So in summary, we've outlined the risks of short selling in shares. It's far riskier than being long in a position because of the margin and max loss potential. But if you would like to short sell, the safest way to do it is through options, either buying puts or selling calls. This is Dalton Grados with Grados Capital. If you like this video, give me a thumbs up, comment below, and subscribe to the YouTube channel. And also don't forget to follow Grados Capital on Instagram. I will see you guys next time.